Selling company stock to pay off your mortgage sounds like a simple math problem. Mortgage rate versus investment return. If your mortgage is 3% and the market historically returns more than that, then the answer should be simple, right? But in real life, the decision isn't nearly that obvious. When company stock is involved, you're balancing concentration risk, taxes, liquidity, and long-term financial independence all at the same time. And for many high earners, this isn't a small decision. We're often talking about thousands of dollars tied up in employer stock and future net worth. Make the wrong move and you could trigger unnecessary tax, stay dangerously overconcentrated, and delay the moment when work becomes optional. Make the right move, and that same decision could significantly reduce financial stress and accelerate your path to financial independence. In this video, I'll show you how to decide whether selling company stock to pay off your mortgage actually makes sense. The key question that completely changes the answer for high earners, especially those with equity compensation, and how eliminating a large mortgage payment can dramatically accelerate your timeline to financial independence. Most people think financial independence is about reaching a giant investment number, $5, $8, or $10 million. But that's only half the equation. The other number that matters just as much is your annual spending. Let's look at two families that may appear financially successful on paper, yet their financial freedom looks pretty different. If one family still carries a large mortgage payment, their lifestyle requires far more cash flow each year. The other family, without that obligation, can support the same lifestyle with a much smaller portfolio. Eliminating the mortgage can dramatically change the math of financial independence. When the money to eliminate that mortgage comes from selling company stock, the decision becomes more complex. Now you're balancing taxes, diversification, liquidity, and long-term wealth all at the same time. Before we even think about the mortgage, start with a more important question. How much of your financial life depends on one company? For many high earners, the answer is more than they realize and more than they like. Your salary comes from your company. Your bonus comes from your company. Your health insurance and benefits come from your company. And your RSUs and stock options also come from that same company. Over time, a large portion of your investment portfolio can end up tied to the same employer stock. That creates a concentration risk many people underestimate. Diversification exists to prevent one company from affecting multiple parts of your financial life all at once. So, the first decision usually isn't about the mortgage, which may be a surprise to some of you. It's about how much employer stock you actually want to keep long term. A helpful question to ask is this: if this money were sitting in cash today, would you invest it all back into your company stock? For most people, the honest answer is no, which is why selling at least some company stock and diversifying often makes sense regardless of what you ultimately decide to do with the mortgage. If you're a high earner receiving RSUs, have stock options, and company shares, you've probably been wondering what to actually do with that growing stock position. And you're not alone. This is one of the most common planning questions I see. Once diversification is addressed, the next question is your time horizon in the home. Some people plan to stay for decades and are well established. Others may move within a few years, might be for job or family. That difference matters. If you plan to stay in the home for a long time, accelerating mortgage payoff can reduce the total interest paid over a lifetime of the loan. But if there's a good chance you'll move in, let's say, 3 to 5 years, the decision carries much less weight. The mortgage balance will be paid off when the home is sold. In that situation, committing a large amount of capital towards a mortgage may not meaningfully change your long-term outcome. This is why the first practical question is, how long do you realistically expect to stay in the home? Before selling stock to reduce the mortgage, consider liquidity. We want to make sure you have solid foundation before we move on to paying off the mortgage. Selling company stock and applying the proceeds to the mortgage converts a liquid asset into home equity, which isn't a bad thing. Home equity is valuable, but it's not easily accessible. And generally, if you're accessing home equity, it's attached to an interest rate. It cannot quickly fund unexpected events such as job loss, medical expenses, or a sudden change in income. For high earners, losing income can quickly create a large gap between expenses and available cash if they don't have a strong emergency fund. That's why maintaining an emergency fund is essential before accelerating mortgage payments. For many households with high incomes and larger financial obligations, that may mean keeping 6 to 12 months of core expenses in liquid reserves. Now, remember, liquidity provides flexibility. Once cash is converted into home equity, that flexibility becomes much harder to access. Mortgage acceleration should not come at the expense of the most valuable savings opportunities available to you. That includes employer retirement plans, tax advantage contributions, and other long-term investment strategies. These accounts provide tax benefits, potential employer contributions, and decades of compounding interest. Giving those up to accelerate mortgage payments is rarely a stronger long-term decision. Now, here's a practical guide that you can follow. First, ensure your retirement and financial independence savings are fully on track. Then evaluate whether additional capital should be directed towards the mortgage. At this point, many jump straight into the interest rate argument, but the mortgage rate is usually not the most important factor. Remember the earlier questions: diversification, liquidity, and progress towards financial independence. Those matter much more. Once these areas are addressed, the mortgage rate becomes a secondary consideration. Higher rates may strengthen the case for accelerated payoffs. If you have a lower interest rate, it may make sense to keep the loan in place, but the decision should follow the broader financial plan, not drive it. When company stock is involved, taxes become a major part of the decision. Different types of equity compensation are taxed in different ways. RSUs are taxed as ordinary income when they vest. Any additional growth after vesting is taxed as capital gains when the shares are sold. Stock options can create a mix of ordinary income, capital gains, or in some cases, there's exposure to AMT, depending on how it's structured. Employee stock purchase plans can also create a combination of ordinary income and capital gains, depending on how long the shares have been held. The tax component associated to your equity compensation should be one of the primary things considered before selling. Now, if you go ahead and sell a large amount of stock, it can trigger multiple tax implications that you might not be ready for. It could also trigger net investment income tax. The key point is this: selling company stock to pay down a mortgage can create a meaningful tax bill. Now, before making this decision, it's important to understand how much of the proceeds will actually remain after taxes and how the sale fits into your broader tax strategy. Again, we need to understand the fundamentals before we move on to paying off the mortgage. But here's something interesting I've noticed after working with a lot of high-income professionals. The decision that looks best on a spreadsheet isn't always the decision that leads to the best outcome in real life. And that's where behavior and personal priorities start to matter just as much as the numbers. Many conversations about paying off a mortgage focus entirely on the math. People compare the mortgage rate to the expected investment returns and try to determine which number is higher. But that approach assumes perfect behavior. In reality, financial decisions are influenced by both behavior and values. Some people place a high value on owning their home outright and reducing required expenses. Others prefer maintaining flexibility and keeping more capital invested. Over the years, I've seen both approaches work well when they align with the person's priorities and the broader financial plan. Ask yourself this question: would you rather have a large portfolio balance or live without a mortgage payment? The key is choosing the structure that supports what you value most and what you want to achieve in the long run. One of the most important effects of paying off a mortgage is the change in required monthly spending. For many households, the mortgage is the largest fixed expense. Consider this: if you have a mortgage payment of $5,500 per month, that's $66,000 per year in required spending just to maintain the mortgage payment. If that payment disappears, the amount of income required to support the same lifestyle dropped significantly. Using a common financial independence framework, a portfolio may sustainably support withdrawals of roughly, let's say, 4% per year. Reducing annual spending by $66,000 could lower the portfolio required to support that lifestyle by roughly $1.65 million. Eliminating that $5,500 a month mortgage payment doesn't just reduce expenses, it can also accelerate the moment when work becomes optional. When clients face the question of accelerating the mortgage payoff, I encourage them to work through a simple sequence of questions. First, ensure liquidity is in place with a solid emergency fund. Confirm retirement and financial independence savings are on track. Third, evaluate whether employer stock exposure is higher than you want long term. Fourth, understand the tax implications of selling shares. Only after these areas have been addressed should the mortgage itself become the focus of decision. Again, we need to make sure that the fundamentals are covered. At that point, paying down the mortgage may become a logical next step, particularly if reducing required expenses and simplifying the financial structure is a priority. Over the years, I've worked with many families approaching retirement or financial independence. One pattern that shows up repeatedly: households that enter that stage of life without a mortgage often experience far less financial pressure. Now, fast forward a few years. The portfolio you've built is covering your spending. The pressure to earn a paycheck every month has disappeared. You wake up on a Tuesday morning and your schedule is yours. Travel, time with family, projects you actually care about. Now, this ideal outcome can be achieved with or without a mortgage. I'm not saying you have to be mortgage free to reach financial independence. Paying off the mortgage can accelerate financial independence, but that doesn't mean paying off the mortgage is always the right decision. You need to first cover the fundamentals: diversification, taxes, cash flow, liquidity, and long-term investing. Then, eliminating the mortgage can become one of the most financially powerful ways to simplify your life. At this point, the decision usually becomes much clearer. The question is not simply whether you should pay off the mortgage. The real question is how the wealth created by your career and equity compensation should be used. Some of that wealth should be used to reduce risk through diversification. Some of it should strengthen the financial plan through disciplined investing. And in some cases, using a portion of it to eliminate the mortgage can dramatically simplify the path to financial independence. One important piece of this decision remains. If selling company stock is part of your plan, you need to understand how those shares will actually be taxed. RSUs, stock options, ESPP shares, and performance stock can all create very different tax outcomes depending on how and when you sell. Without planning ahead, it's surprisingly easy for equity compensation to create a large and unexpected tax bill. In the next video, I'll walk you through how to plan ahead for vesting and stock sales so you can avoid surprise taxes and turn equity compensation into long-term wealth. Click right here to watch that next.